Good morning, Peter. Good morning, everyone. And thanks, Peter, again for the invitation to this event. Just a few words about myself. I'm originally from Italy, but I live and work in Vienna for more than 10 years now. I divide my life between academia and practice. I am, from an academic perspective, the managing director of the WU Transfer Pricing Center at Vienna University of Economics and Business. You see the nice campus we have in the background. So if you are around Vienna, it's worth a visit. And from the practical side, I'm an advisor on tax, international tax and transfer pricing issues. Today we will present a little bit what's going on in transfer pricing, more specifically, how transfer pricing is understood from tax people and how it is understood from accounting and finance people. So I would try to clarify the differences between your understanding of transfer pricing and the tax understanding of transfer pricing, because these differences often in practice play a significant role. Then I'll give you an introduction of what is going on in around the world on these topics and touch upon briefly on the technologies, new technologies you can use nowadays to deal with these issues and those that you hopefully will be able to use in the future. And then have some conclusions, some concluding remarks. Feel free to unmute your microphone or text, whatever you prefer. Also, during the presentation, asking questions, clarifying issues, and of course, let me know if my English is not perfect and so you don't understand some terminology, or you're not familiar with some terminology that I'm using. So here we go. What is transfer pricing? What do you think transfer pricing is? Actually, this is probably a big question when you ask people around what people think transfer pricing is. And most of the time I get this answer: transfer pricing is the price of goods and services that is charged between different departments, different offices, and or different entities in the same multinational. So this is a pretty good understanding of what transfer pricing is, but this is the understanding that people usually in accounting or in finance think or know transfer pricing is, which is absolutely correct. Transfer pricing is indeed mostly about the price that you have to charge when you exchange a good or a service between different departments or different entities of the same group. And this is important, of course, because all the departments need to somehow be compensated when they exchange goods or services with each other. But when you ask a tax person what transfer pricing is, well, they usually have in mind transfer pricing legislation. And transfer pricing legislation is rather the set of rules, tax rules, that a country includes into its legislation in order to avoid that a company, when transacting with another company of the same group in a different country, then would shift profits outside the country. And this is something that makes things a little bit more complicated. Not that they are simple from the accounting or finance perspective, but they get even more complicated from a tax perspective. And let me tell you why with an example. You see here, you might have a company established, a group established in the US. Here you have Apple with a manufacturer in China and a distributor in Austria. The manufacturer buys somehow the materials that it needs in order to manufacture his phone. It sells, produces the phone and sells it to Austria for 700 euros, makes 300 of profits, and the distributor sells that phone in the local market in Austria with the Apple store for 1,000 and makes 300 of profits, and the overall group makes 600. Now, when you ask a person that works with accounting or in finance, what is transfer pricing? What do we have to be careful at? Most of the time, the question will be, okay, what is the price of this product? What should be the price of this product? And how do you derive that price? You have several approaches. Probably the most common approach in this case will be to take all the costs that you need in order to manufacture that phone, the direct cost, eventually also the indirect cost, add some markup, some remuneration for the manufacturer's activities, and then you end up with that 700. Does someone questions that 700? Not that much, because of course it is important from an accounting perspective to make things correctly, but we are talking about internal accounting here. So it is something that is important for performance measurement. It is important for eventually third-party shareholders. It is important for various reasons, but it is not the ultimate way to answer the question from a tax perspective. From a tax perspective, from a tax understanding of transfer pricing, what will be important is not only this price, but rather answering the questions whether the contract that you have signed between the manufacturer and the distributor is something that is in line with reality. Whether two independent parties would have signed a similar contract with similar clauses. Also, whether the transaction makes commercial rationality, whether two independent parties would have somehow designed the transaction in a similar way, or whether they would have structured the transaction differently. Then the question comes on whether the methodology you use is the most appropriate one, and there are typically 5 methodologies that are used in the tax world to define that value of the transaction, and it's often not clear which one should be the correct methodology to use. And last but not least, the question of whether ultimately out of this transaction, the profit, and not just the price, but the profit that the manufacturer makes, the distributor makes, is at arm's length, is a profit that two independent enterprises would have agreed upon. So you see, that's the reason why I say from a tax and perspective, transfer pricing is something different than what it is from an accounting and finance perspective. And that's why I believe it's something a little bit more complex, even more complex than what it is from an accounting and finance perspective, of course. So this is just for you to know when you speak with your colleagues in the tax team, that somehow you are aware that there are differences between the way that accounting and finance see at transfer pricing and the way that the tax function sees at transfer pricing. Now, what I wanted to let you know is what's going on with this issue from an international perspective. What are the hot topics? What are the discussions currently going on? What eventually you need to be careful at when you are dealing with transactions between separate departments or separate entities within the group. So this is a list that is, of course, not exhaustive, but a list that shows you what's somehow going on here. Services are very important. Services are something that are commonly exchanged almost every day within companies in the same group. And the question often comes not only about what is the price of the service, but rather what is the understanding of that service, whether you really need that services or not, whether you can charge those services to the companies or not. So this is something that is often coming as an issue in multinationals. Financing, this is a topic that, of course, all of you are very familiar with. So when you have an intragroup loan, when you have guarantees, cash pooling, factory, and so forth, when you have something between one entity and another, a flow of money between one entity and another that should generate compensation because it is something that provides benefit to the other entity. Then the question comes often about the interest rate, for example, the remuneration for that product, for the financial product. But from a tax perspective, the question is also whether the contract, the financing agreement that you have put there is actually fine, and whether the structuring of that financing transaction is fine. Next big issue that creates often headaches is intangibles. Intangibles, something that we don't see, we cannot touch, but they are very valuable for multinationals. Think of the brand of the company, think of all the intangibles out of the R&D department of the company, think of software, think of formulas, think of all those activities. Of course, they are something that they are very difficult to understand where they are and who is doing what when referring to those intangibles. But tax administrations are putting a lot of attention to those transactions because they generate a lot of value. Business restructurings, when you move some people from one entity to another, when you are moving functions or even assets or risks from one entity of the group to another, then the company that loses those people or those functions should be remunerated in a way that a third party would have been remunerated. And of course, here, the tax administrations of that entity will carefully look into that movement. So even if you have not eventually explained that there was movement of people or functions in your documentation, in your transfer pricing documentation, you still have to be mindful to be ready to answer questions about your movements of people and functions within the group. Interplay with customs and VAT, of course, transfer pricing interplay is useful not only for direct tax purposes, but also for customs, and on top of customs, there is VAT. So once you make something wrong from a direct tax perspective, then you might have issues also with customs and VAT. So that makes things even more complicated than what you might think if you only look at the direct tax aspects of the topic. Digitalization of the economy, of course, a lot of companies are getting more and more digitalized, including in the finance sector, but not only. So, of course, here There are some discussions now at the international level, what to do when you perform some activities in a country without having any presence. Should you pay taxes into that country? Well, normally not, because if you don't have any presence, you don't have to pay taxes typically. But governments and international organizations, tax administrations are starting putting that concept in discussion, and they're starting saying, well, if your customers are there, if your revenues are there, even if you don't have any presence in terms of a company, in terms of people, in terms of a permanent establishment, an office or something, still you might have to pay taxes into that country. And this is something that both the OECD and the United Nations are trying to solve. They're trying to come up with an answer, but it is still far away from being agreed or at least implemented into the legislation. Global mobility of workers. We've found out with pandemic that many of us can work from pretty much everywhere. So this creates a lot of headaches to companies because you might have issues of permanent establishments. You might have issues of how much profits to attribute to those permanent establishments. You might have issues with transfer pricing, business restructurings, and so forth, not to mention, of course, all issues you might have from a social security perspective. So this sure is or will continue to create headaches to transfer pricing experts. Here, a brief overview on the case law. So what are the type of transactions that are mostly discussed between taxpayers and tax administrations? You see here a list that confirms at the end of the day what I just told you. Financing is the most discussed issue between taxpayers and tax administrations. Intangibles are also very much in the discussions. Goods and services, yes, they're there. They're not the main one, but they are still very important. And business structuring is coming up more and more in those discussions. Here are the issues that are typically discussed. You see transfer pricing methodologies, how to apply those methodologies are often there, but there are more and more discussions on who has the burden of proof, whether you have made an appropriate documentation, transfer pricing documentation or not, whether you have an interplay with general anti-avoidance rules, losses, permanent establishment, and recharacterization issues. Now, before completing, I just wanted to give you an overview on the technology that eventually are available or can be available there in order to manage those transfer pricing issues. Well, first of all, when looking at the transfer pricing life cycle, you start from planning strategies, guidelines, and eventually doing some benchmarking of the transaction. You then go into the pricing part of your analysis. You monitor those prices. You try to make sure that those prices are correctly applied. Eventually, you make transfer pricing adjustments in case monitoring those prices, you find out that the prices applied are not those that you should have applied. Then you write everything in a nice transfer pricing documentation. You make contracts, you make all in line with the documentation requirements by the tax authorities. Then, of course, you have to manage the relationships with the tax administrations. You have to discuss with them whether the outcome of your analysis are somehow in line with what their expectations are. And active management is, of course, very important. Things change often in a company, things change often in the tax world, and so you need to always be having an active management of all these issues. Now, we have a lot of new technologies available nowadays. Some companies are more advanced in using those technologies for their tax issues. Some companies are a little bit less into this topic, but for sure, in the future, we will have to use more and more technologies in order to deal with all these issues, and also in order to manage our TP life cycle. What I see nowadays in the most advanced companies is that there is the possibility already with the technologies that we have now to eventually monitor the prices, in some cases even doing adjustments to those prices whenever they are not correct. Some benchmarking tools, more and more technological benchmarking tools are coming up. In some cases, you find also technology solution for compliance and documentation, but those technologies, in my understanding, are still not perfect. So you always need people that are experts on the topic in order to understand whether you are the outcome of what technology makes is indeed the correct one. So what should companies do? Just a short list for you to take notes and bring it home in order to understand whether you need to change something. Well, first of all, this is of course something that is I'm a little bit biased for, but it's extremely important to always continue to do trainings and knowledge. You should train your colleagues, your employees, because without knowledge of what is going on, of course, it becomes difficult to even think about all these issues. Then it's always important to build up a robust TP lifecycle, the ones that I explained you before, something that involves a lot of processes, a lot of standardization, a lot of clear guidance on the transfer pricing internal policies, on people, on responsibilities. I always say technologies doesn't make miracles. You need to have a well set up process, a well set up allocation of responsibilities in the company in order to make the technology, making that the whole setup and the whole process working well. And then once you have all this, you can implement technological tools whenever possible, whenever available. Please, as I said before, keep in mind that they are not yet perfect, but they are useful in many circumstances. They are useful to deal with all these issues. And last but not least, try to prevent dispute. Try to proactively engage in discussions with tax administrations. It's always better to discuss issues in advance rather than waiting the tax audit to come, because when you discuss things in advance, tax administrations are usually more open to somehow get an agreement on a solution you might find, rather than in tax audit environment where there is a constant conflict between taxpayers and tax administrations there, and it's difficult to get agreements. There's a lot of opportunities. There are a lot of tools coming up, especially in Europe, but also beyond Europe, in which you can discuss in advance with tax administrations, from the traditional rulings and APAs to more innovative tools like the ICAP program or the joint audits. Those are tools that are coming up more and more in Europe. And so please be mindful that those are very helpful tools. So here you go with my contact details in case you want to get in touch, in case you want to just follow what we are doing in Vienna. In case you want to get in touch for a transfer pricing issue you have, please feel free to email me or to contact me on LinkedIn. And now I'm happy to answer all your questions. I hope this was not too boring for you, and I kept you awake even in this part of the day.
Thank you very much, Raffaele. Thank you. I have a few questions actually. Can you just go back to the TP life cycle? I have a few questions in that slide, especially. So, this is a very obviously kind of a long process in terms of, and there's a lot of moving parts. So, what, in your opinion, what do you think? In your experience, I would say, in which part of this life cycle companies are mostly struggling with, and what do you think? Why is that?
Well, I think it's a very broad question, and I think it depends on the specific company. But just to give you a more direct answer, of course, strategies and guidance often are not clear or are not agreed, or even if they are agreed, they are forgotten. Not everybody reads them, not everybody updates them, and so this is something where you struggle with. Pricing is something that every company does anyway, so they try to price their transactions in the best way possible, also because it is not just a tax, but it's also an accounting and finance issue. But monitoring the correct application of those prices is also another issue. So monitoring for sure is something where you struggle with. TP adjustments, once you are good at monitoring, then there are something that are not a big struggle in compliance and documentation. Well, I see all companies now getting compliance and documentation on issue well established. So this is something that is improving, although it's still quite an issue to set up contracts and transfer pricing documentation for every type of transaction. Relations with tax administrations are still something difficult. So if I would have to make a list of all these issues, probably I would put on top of it strategy, monitoring, relations with tax administrations as my top three.
Perfect. Thank you very much. And in terms of the future, what do you see? What the companies should prepare for in terms of maybe requirements or compliance or new regulations coming out? What do they should pay attention to?
So as I was mentioning before, I think they should pay attention to those type of issues I mentioned before. So all those list of topics, services, financing, intangibles, business structurings, and so forth. What is coming up next in the work from the work of international organization is more guidance on how to deal with the increasing digitalization of companies' business models, how to deal with remote working related tax issues. And so those are the new topics that probably will soon or relatively soon see more updates. And from a more country-specific perspective, please keep in mind that a lot of countries are updating or introducing transfer pricing regulations. So even when you think that things are going well and well set up in a country because those topics were already set up some years ago, unfortunately, countries are constantly providing new guidance, new legislations, new regulations on these topics. So this is something that constantly need to be monitored as well.
Perfect. Thank you very much, Raffaele, for the presentation and for joining us. Thank you.
Thank you very much for the invitation.